Well, hello, Canada. I got a riddle for you to start off. What is 51-26? It's not my locker combination. It is the Toronto Maple Leafs record this year. And so let's have a big shout out for the Maple Leafs. Those of you, obviously, in the rest of Canada that don't care about Toronto are probably quite upset with me. But as a very depressed Toronto Maple Leafs fan, this is the year. Okay, I said it. It's out of the way. Let's move on. The market is having trouble holding a bid. Today was a perfect example of market that opened strong, had some promise, and failed miserably by the end of the day. That type of behavior is not seen, ladies and gentlemen, in a bull market. It is seen at the very end of the bull market or in the midst of a bear market. And so, you know, as Powell was speaking today, Lagarde was speaking, they were talking about being hawkish. The markets just haven't liked that talk. And this week, the Bank of Canada reaction to inflation, we're going into a period where we don't have a good environment for both stocks and bonds, and it's going to become increasingly difficult to navigate over the next 6 or 12 months. So, you know, tonight's focus a little bit different. Focus on ESG investing, and we'll get into it right now. But first, again, a shout out to our various sponsors for putting these events together, and very specifically to our great educational partner in Bank of Montreal, ETFs. And if you haven't already made a donation, if you have, thank you so much. This year's campaign for Sick Kids and Baycrest is well on its way to meeting or exceeding our goals. For my personal focus on the Baycrest Foundation for Dementia and Alzheimer's, this year's goal is $75,000. We're getting close. We're almost at $60,000 right now. So, you know, let's try to put us over the top in the final couple weeks here. Next week is the last week of the webinar series. We're going to be focused on private debt and equity next week. In going into a difficult environment, alternatives are very important. One of the alternative types of lenses we're going to look at this week with Drew Burgess from BMO ETFs, along with our theme, is going to be ESG investing, and I'll carry on that through the rest of the presentation. So Drew is joining us from Ottawa tonight, our nation's capital, and possibly one of the worst hockey teams next to the Montreal Canadiens. Take it away, Drew.
Thanks, Larry. I can't argue with you on the hockey team analogies there and comparisons, but yeah, excited to be here again. Thank you for having me, and it's a pleasure to join you and the team and all the viewers at home. I'll get the required disclaimer out of the way first as a formality. The information I'm going to share tonight is strictly for informational purposes only and does not represent any recommendations or investment advice in any part, whether on investment, tax, or legal matters. So I'm going to jump right into the discussion and the topic: responsible investing, as Larry mentioned, ESG, and timely in light of Earth Day. I believe it's tomorrow, if I'm not mistaken. So a big shout out to Earth Day. And over the next 10 to 15 minutes, my goal is really to leave you with some greater insights into responsible investing, ESG, and what we're doing at BMO really as a leader in responsible investing, and a few actionable a few ESG ETF solutions. ESG ETFs in Canada, as you see on this slide here, just a frame of reference, not highlighted on this slide, but in 2020, we saw just short of $2 billion of flows into ESG ETFs. In 2021, we saw over $3 billion of flows into ESG ETFs, and we're continuing to see momentum into 2022. We saw the number of ESG ETFs also double from around 50 ETFs in 2020 to 100 ETFs at the end of 2021. and we're anticipating more to come to the market through the remainder of 2022. Now, these are still the early innings. Predominantly what we're seeing in ESG, ETF flows is dollars moving into equity-focused ESG solutions. So as highlighted on this slide, for the month of March, and this has been the broader trend over the years, more ESG equities versus fixed income. But we again are in the early innings, but the research and data is really continuing to support ESG investing across both equities and fixed income. There are a few overlapping themes on the next slide that we're hearing more about today than ever before, and this really sets the stage for what I'm going to talk a little bit more about through this part of the presentation. We're hearing more and different perspectives when we think about responsible investing. Some topics or themes that are more broad in scope, some that are more precise. When we hear and think about terms such as socially responsible investing, ESG investing, as well as clean and renewable investing, just to name a few, these all have a common foundation, and that really being a focus on looking to the future, investing for the future, and investing with companies who are changing for the good, and effectively in tandem with our ever-evolving global demands. ESG, and its at its core, really takes a precise look through three pillars that you see on this slide: environmental, social, and governance factors, and really seeks to invest in higher ESG scoring companies across all three of those categories or those pillars. Now, what was once unmeasurable is now measurable on the next slide. The data and evidence continues to improve and continues to support the case for incorporating ESG factors into the investment decisions. And in fact, what we do see is the general market trend towards ESG continues to be in demand. It appears, in fact, that ESG transition won't be hindered by global disruptions. Rather, it's likely that we, in fact, could see ongoing acceleration towards faster adoption of ESG and impact strategies as things like social issues, societal issues come to the forefront in many discussions nowadays, and we're seeing in the headline news and media, as well investors feeling a greater sense of urgency to make an impact and align their investments with not only environmental goals, but also these societal objectives and corporate governance concerns. So we're seeing segments of the markets really turbocharged, partly as a result of what we've been through with COVID. And there is undoubtedly the shift that we're seeing and the impact each of the E, S, and G can have when we're looking at the long-term sustainability and looking to invest in companies with higher ESG scores. And people are ever more aware of what's happening around the globe, and arguably, I say, less tolerant of the impacts that E, S, and G factors can play on a company's market value and stock price. So what is our stance on responsible investing at BMO? I often am asked this question, and it really goes beyond just our ETF business. BMO Financial Group continues to take a leadership role on responsible investing. We are leading the charge on education, engagement, integration of responsible investing and responsible thinking. As one example, I think back to, we were in December of 2020, we were actually a founding signatory to the Net Zero Asset Manager Initiative. The mouthful, but it's effectively BMO GAM's commitment to work with our clients to achieve net zero emissions across all assets under management by 2050 or sooner. So our approach to driving change and awareness can further be seen through what's highlighted on this slide. At the core, two broad themes are our responsible investment team is really focused in on, and that's climate action and social equality. And the change in those two themes is driven through the four items on the left-hand column. The first being thought leadership. This is strategic, thought-provoking activity across the globe, sharing best practices and actionable insights. Second is stewardship, and I'll go into more detail on the following slides, but we're actively engaged in proxy voting, oftentimes voting against management and taking a stance to really push for more positive change across the companies that we work with and invest in. The third one there is ESG integration. This effectively across our full suite of investment products is where we put an ESG lens on before deploying capital. And sustainable products and solutions. This is where we are forward-looking, innovative in why and when we bring new products to the markets, as well as we bring insights alongside new products to help investors to really be well-informed and educated on BMO's responsible investment approach. Now, stewardship, I'll go into a little bit more detail on this on the next slide. Yeah, thank you. It's one of the core elements of a responsible investment approach. And at BMO, this is on a firm-wide basis, so not just exclusive to our ETF lineup, it spans across our mutual funds as well. Stewardship is all about interaction with companies to enact change, one-on-one discussions, proxy votes, as well engaging with policymakers and governments to advance ESG issues across entire markets and geographies, like across Canada or the US or broader regions. And a lot of investors miss this, that there is an ETF provider behind the scenes, for example, in charge of proxy votes, making votes on behalf of investors, working to make those proxy votes well-informed, and bringing a high level of engagement at the company level. Currently, and I just found this out today, actually, the responsible investment team at BMO is in proxy season. And I didn't know that was a thing, but it's a 2 to 4 month period throughout the year where the team is engaged in ongoing shareholder meetings and voting. And a few of the issues the responsible investment team is actively engaged in voting include adequate board and company oversights on ESG, board diversification and gender equality, executive compensation, whether they agree or disagree, just to name a few. Now, most of the dialogue with companies last year was spent on the climate theme on the next slide, setting shorter term emission reduction targets for 2030, setting longer term emission targets for 2050, engagements around board oversight and managing these types of climate goals, and the level of transparency that the board is providing. Now, the focus more recently, and this was interesting, is there has been a shift more recently away from the climate focus. It's still obviously a huge component, but the focus lately has been on the social equality and workforce issues as a result of the pandemic. So things like wages, inclusion in the workforce, our employees being heard, and employee-employer relations. So there's a lot happening behind the scenes. There's a disciplined process. Now, with all of this work that is happening behind the scenes with stewardship and company engagement, our responsible investment team really likes to track and know what kind of impact they are having. And again, they do track this. And all of these engagements are tracked with milestones. So progress a company has made on a specific issue that has been brought up and addressed. There is a scoring system to keep track of how many positive outcomes they have had. So clearly very engaged, very disciplined, and a very objective process. Now, I wanted to share a few different types of ESG ETFs to bring more awareness to what is in the marketplace. On the next slide, broad market ETFs. Some of you may be familiar with these. They usually cover specific regions such as Canada, US, EFI, and we've even gone further to include ESG China and ESG India with recent index changes and alignment with MSCI's ESG Leaders Index. broad market ESG ETFs with MSCI as our index partner. We think about MSCI, you may have heard that acronym. They are a leader in ESG indexing, and I'll share a little bit more on them on the future slide, but they have a dedicated team of over 200 professionals who all they do day in and day out is research, score, and work with companies on improving ESG metrics. So these broad market ESG indexes represent the highest ESG scoring companies with sector diversification very similar to the non-ESG broad market exposures. ESG themes, you may be familiar with as well. These can be thought of as focused solutions. For example, clean energy, renewable energy, fossil fuel free strategies, women in leadership. This solution, an ETF and a mutual fund we have, brings more focus to the governance, the G part in ESG. And the third type of ESG ETF, asset allocation ETFs. On the next slide, a quick look at our ESG ETF suite. The shelf has been undoubtedly expanding. We passed our 2-year anniversary in July of this year for our MSCI ESG Leaders ETFs. Those are the broad market ESG ETFs. We have partnered with MSCI to a large extent for our equity ESG ETFs, tracking these, and I've mentioned ESG Leaders indexes a couple of times now, but they are one of the most widely tracked ESG indexes in the world. I also mentioned we have an all-in-one asset allocation ETF, seen here, ZESG. This strategy uses the MSCI Leaders ETFs as building blocks to construct a portfolio you can invest in a single ticket, low cost with automatic rebalancing. If you want to see an overview of all ESG products in Canada, it is available. You can visit the RIA website to have a closer look across all providers offering ESG solutions. And to close off, if you are interested to hear more from us on our market insights, including ESG, more on renewable energy on the last slide, other timely topics, we run a weekly Market Insights webinar Fridays at 1 p.m. A bit of a twist. Next Friday, we have a new format with a couple sessions titled Spring into ETF Investing, where we are bringing a different flavor of personality to the discussion, surely to be insightful and entertaining sessions. If you're interested, I encourage you to join us, and you can register at www.etfmarketinsights.com. And with that and time in mind, I will pass the stage over to Larry Berman.
Drew, thank you so much for that ESG introduction primer and a little bit of an advance on what I'm going to talk about tonight. So appreciate that, and thanks so much for the BMO support. Someone did write in a question already tonight asking about, because I mentioned next week's would be the last webinar. The week that we had canceled due to my COVID illness, initially our marketing people thought we could just add a week on the end. They didn't check with me first. My calendar doesn't permit it. So what we did was we went out to BMO and said, hey, can you fit us into your spring into ETF investing theme in May? And I'll be appearing on a Friday version of ETF Market Insights later in May, and we'll send out a notice about that. So great on that end, and into tonight's topic. Go Leafs, go, go. No, I just got, you just have to know how crazy a Leaf fan I am. Anyways, okay, so geopolitically this week, not a lot has happened on the news side of things. From the Bank of Canada, a little bit of update there, so I'll cover that, and then I'll get into what I wanted to discuss in ESG and some thematics that I'm looking at to put on my radar today, and then of course we'll dig into the Q&A. So I was at a charity event last night, and was asked by one of my colleagues there, what I thought about you know, the Taiwan issue. And so that day, we had seen released on Taiwanese television a warning that China was invading. So what it turned out was that they have a planning day for a national attack, and they had this whole thing kind of lined up in the queue to test. The testing wasn't going to be for another week or so, and somebody released the wrong button apparently. I don't know. Anyways, you know, you had these headlines kind of cross the tape that Taiwan was being invaded. Anyway, somebody asked me about it yesterday and what I thought, and so I thought it would be a good topic to cover tonight. You know, the Taiwan is largely known for in the world for its contribution to the semiconductor space. Taiwan Semi, biggest semiconductor company in the world. Hymex. There's a handful of others. So as China likes to do and has certainly shown a pattern of doing over the decades, they like to replicate people's intellectual property and make it their own version. And so that's been a big issue for the US. It's part of the technology war. If they were to invade Taiwan in an aggressive way, much more aggressive than they are currently invading Hong Kong and the freedoms that Hong Kong has had prior to the turnover a couple of years ago, that it's very possible if the U.S. Came to the defense of Taiwan, which they have stated they would, because they believe that it's a sovereign. Why that's different than what would happen in defending Ukraine, having encouraged Ukraine to give up their nuclear weapons in the 90s in you know, and mutual support by Russia. Anyways, all that, it's complicated is the answer, but from the pure economic perspective, there's no incentive today and probably for the next 5 to 10 years for that kind of intervention. In my mind, it's inevitable. One day it will happen. I don't think it's anytime soon. I don't think we need to price it into portfolios today. And I don't think we need to be overly concerned about it from a systemic risk standpoint. But what's going on with China aligning with Russia and the East and West and a digital currency that China's pushing, that literally, there's going to be less globalization than there was, but China realizes still now and for the foreseeable future, they need the West far more than the West needs China today. The onshoring of technology, Intel investing $25 billion in plant and equipment and bringing more domestic, all that's inflationary. It's all going to add to the issues that inflation's going to be a lot stickier for a long time. You know, less benefit to lower wages and production in more efficient markets, etc. So we're in a period for the next decade or so where that transition is going to be big. Talked about a few weeks ago, rechanneling the distribution of Russian oil and gas to Southeast Asia and India, who are by all intents need low cost or lower cost or cheaper, whatever you want to call it. And for them, that trumps the awfulness of what's going on. China obviously doesn't have a big problem with Russia invading Ukraine because they have the same desires on Taiwan. And but I don't think we have to worry about that today. But it was certainly interesting when those headlines kind of hit the tape the other day, and I thought that would be interesting. But no new movement on the Ukraine-Russian war front. More propaganda, more false headlines. I said a few weeks ago, May 9th is a very big day because it was the Russian Freedom Day, when they basically rolled into Germany and helped the Allies win the war. So that's a big day for them, and I believe that day or around that day they'll declare victory, whatever that happens to be. The fact that they launched an intercontinental ballistic missile and more noise than anything else. The markets have mitigated the sensitivity despite the tragedy on a human toll that's going on in Ukraine right now. Obviously, the NATO and NATO countries are increasing their support for Ukraine as much as they possibly can without the overt support of actually sending in troops. On the Finland and Swedish side joining NATO, that's probably going to happen in the back half of May. So we'll see how it all plays out. But I'm virtually certain that it's not going to escalate to the point of nuclear weapons pointing at each other, DEFCON, kind of movements. But those odds aren't zero. You don't have to price that into your portfolios today. You got to be mindful of it, certainly. And for those of you that are going to ask, it's not a reason to own gold. So with the ESG lens on, which is our focus tonight, I came across a Bloomberg article that was put out not long ago, maybe a couple of days ago, where they were looking at the European market and their increased use of coal because of less need and demand and want for Russian oil and gas, basically in the last year or two. And you can see a notable increase, obviously, in the last 2 months. The orange line there, which is energy developed from coal. In fact, you can argue that over the last year, basically since Germany started really decommissioning a lot of their nuclear facilities, relying on coal. Like, how dumb a choice is that? They surely had to expect some of these issues with Russia. But in any case, Nord Stream 2 was going to come on. They were going to have all the cheap supply they needed, and that story is over. So, when I'm looking to do research in this area, I look for imbalances. I look for stuff that, okay, how are they going to solve for this? What's the solution? And so the next chart here, again, all related to geopolitics, is hydrogen. So a piece of research came across my desk today. So Germany is planning a massive hydrogen facility that is basically, by the end of this decade, going to replace all the capacity that Nord Stream 1 and 2 were going to supply by way of energy, clean natural gas. And in the interim, by 2023, LNG is going to be that intermediate driver of the energy creation in terms of the hydrogen until they get the structure fully going. So, one of the ESG thematics is hydrogen. I covered it. It's got to be a couple months ago on BNN, and I mentioned this ETF, HYDR, as something that was kind of on my radar as the term I started to use in my weekly YouTube video. in the January and February period, where this is looking very interesting, and so we had a good recovery off those lows, and we rallied. Now we're starting to break down again. When you look through this ETF at the holders, you see Plug Power and Ballard Power, and I think I commented a few weeks ago. I remember sitting on the bond trading desk at CIBC, and it was either late 90s or early 2000s, and Ballard Power was the world's solution, because when you have a hydrogen power supply, water is your byproduct, and it was abundant and unlimited in the world, because hydrogen is a natural element. And anyways, 20 plus years later, and it's still not viable as a large source, but we're getting closer. And so this is interesting, and it's on my radar. And for the ESG oriented folks that are looking for something, I don't own this today. It's on my radar. I don't own it today because of relative risk and volatility. This from falling from 18 back down to 14, to me, in a risk-off market, would be minimum, is going to fall a lot more than the S&P 500 and some other things that I would kind of currently hold and ultimately sell to buy something like this. But it's very interesting, and I would keep an eye on it from that lens. So this is the idea that this week really came out of my analysis of global macro and geopolitics, and looking into what happened this week and what it meant for markets and what markets moved, and ultimately try to find a solution to this coal problem. And so short coal, long hydrogen might be interesting as a trade here, for those of you who do that kind of thing. Okay, Bank O Canada. So the inflation numbers that came out yesterday were magnitudes worse than expectations. Every one of the bank's economics teams came out and upgraded their calls and forecast for the rate hike cycle. And if you look at the BA market, bankers' acceptance is basically the equivalent, or it's very similar to what LIBOR or Eurodollars are in the US. So it's the floating rate funding market. This is the futures curve that would trade in Montreal. And what you can see here, which is very similar to the US, is that we have this rate hike cycle coming more aggressively. The steepness of that curve in going from 98.25, 98. So that 98.10, approximately where the current future is, would give you a 3-month rate for May on the BN. So you're talking about a little bit of bank credit risk, with a 50 basis point rate hike coming, or maybe a 75 basis point rate hike coming at the next meeting. But by the middle of 23, certainly the third quarter, you could see the peak in rates. 100 minus the number here is your yield. And then rates start to fall, so the price starts to go the other way. And that's what's happening with the US curve as well, in that they believe the central banks will overdo it, and they'll start to have to ease towards the end of next year because we're in a recession. So that's where the money markets are. Canada is in the same boat, if you will, as where the Fed is. Obviously, we're not the reserve currency of the world, and we kind of have to pay attention to what the Fed's doing, but the hawkish rhetoric is elevating significantly. In the conversation today that they had with the IMF, with ECB, with Powell on the panel, if you saw it on Bloomberg TV, they covered a little bit of it on the US channel. I think it was a little bit on the Canadian channel, but very briefly. It was certainly on Bloomberg Radio. For those of you, download the Bloomberg app. I think you can get the Bloomberg Radio for free. Maybe something you can look into. But anyways, point being that Madame Lagarde recognized the supply side shock that was driving inflation, and that her tools were somewhat limited in terms of fixing that. And as that narrative was coming out, you started to see the stock market sell off accelerate today. So that was kind of interesting. So Bank O Canada. Okay, one of the things I wanted to talk about was this greenwashing, and Drew talked about the rapid growth in ESG focused strategies. I'm launching an ESG fund on the Q Wealth platform for clients internally on the Q Wealth network. It's not going to be an externally managed fund. In fact, most of the funds I manage are on the Q Wealth platform these days. We still do have the 3 BMO funds we run that most people could buy. But greenwashing is the term that was put out a number of years ago, but really how people were for marketing reasons, were putting a label on something, but weren't really doing what they said they were going to do, and doing the homework. And so because of green and everything else, it's fit in really nicely as a label. I was listening to a webinar probably 6 months ago that the Ontario Securities Regulators was hosting, and they talked about greenwashing in this industry and be careful of it. So it is important that when someone labels something green, ESG, that you kind of understand that they're really doing that. It doesn't mean no energy. That's not, what a lot of people think. It just means, a lack of energy or no energy exposure, or specifically no oil and gas or carbon, and that's not at all what ESG is. Drew covered a little bit of this in his chat tonight. And I'm going to mostly focus on the environmental piece tonight versus the social and the governance. When Drew talked about voting proxies, that's a lot to do with the governance aspect of making sure the corporate is there's oversight, there's business ethics. When there's a ethical violation, whether that's inappropriate behavior in the office regarding men and women and colleagues and that kind of thing, that it's dealt with properly. Excessive executive pay, all those things where voting comes out and really matters. The social aspects of things can be child labor laws and human rights. So how does Saudi Arabia get to be the head of the UN Human Rights Commission, like whatever, anyways. And then of course health and safety in the workforce. There's a lot of aspects to ESG, and tonight I'm just going to focus on the environmental, because for a lot of people that is the lens, that's what we think of with ESG, but it really is much broader. When you get a ranking of an ESG company, that ranking covers all aspects of this, not just their environmental footprint. We talk about net zero and our clean planet, and it is very, very important. One of the things we learn when we do analysis of ESG companies, and I think this is really, really important. A company's cost of capital is directly related to when they issue a bond, how much interest they have to pay in the public market. When they issue equity, what multiple do they get for that equity? And companies with a high ESG score relative to companies with a low ESG score have a higher cost of capital, which means their PEs are lower, and that's not a bad thing per se if you're a value investor, but that's a whole different thing for a lower PE, okay? And then their cost of debt is higher on average, and it can be material, and what that means is it directly impacts profitability. So when you do a screen for ESG, it's a very, very similar lens to a quality screen, but it doesn't factor in the environmental. It's directly related to this cost of capital, folks, and that's one of the things you can feel very comfortable about when you take an ESG lens or you add that ESG lens, is that you're generally getting companies that ultimately are going to be more profitable because they have a lower cost of capital, and in addition to being good corporate citizens, which is, you know, the primary reason behind it. One of the things that was in this article that I featured this week on BNN was this, and you know, it's literally 2 seconds before we were live back to me for the educational part of the show. Producer whispers in my ear, tech is out, charts are down. And so I'm doing this, that I prepared to show you all these charts, and I couldn't show them online because we didn't have the capability of it. Anyways, stuff happens on live TV. But this is one of the things I wanted to touch on, because a lot of people think that ESG funds, you know, can be just lower energy or, you know, overweight certain sectors than other. Now, when you do run that ESG lens, you tend to get a little bit of a skew. And a good ESG strategy will not change it from, say, the traditional market cap weighted index. So whatever the S&P 500 is, or whatever all funds are together, which effectively would be the, you know, the market, compared to this ESG lens. So technology companies tend to be more profitable. They tend to have less of a carbon footprint. They tend to be more green. In sectors that they're office-related jobs, as opposed to mining and some of the dirtier type of jobs, if I can use that phrase. So there tends to be a bit more of that. The finance one is interesting, why that would be actually a lower lens. But the main reason why finance is lower is because the gross difference in pay scale between the C-suite and everybody else, and that the finance companies, the banks, whatever you want to call it, in general, don't always act in the best interest of their company, their customers. They're never going to say that out loud, and I'm not naming names at all. But again, when you do the ESG rankings and you think about corporate governance and everything else, you know, that's one of the things that jumps off the page. But for the most part, most industries are pretty similar, and a good ESG fund is not going to be just X energy or X something. It's going to be equal exposure, better corporate citizen. So with that lens on, I really like the Just Capital ETF. It's run by Goldman Sachs. I featured this last year when we covered ESG in this series of webinars. The website is there. The link will be there, and you can go to it. But if you typed in Just ETF, Just Capital, you'll find it. They list the 1,000 companies, Russell 1000, and the ESG rating, and they break it down by the industry they're in and so forth. And you can see on the top 10 list here how much the technology sleeve is evident. Right? It's you know, obvious. But when you look at the broad S&P 500, you don't see PayPal, for example. But obviously, you know, you see Google and Microsoft, not Intel. It's not one of the big ones anymore, Apple, and so forth. When you drill down and look at the sectors, they rank every energy company. Every energy company has a ranking. Now, the highest ranking energy company I think, is 55. And in 2021, that number one ranked company was Chevron, and this year it's ExxonMobil. Now, I haven't looked into why exactly they made that shift between the two behemoths. I imagine it's related to some of the ESG factors, but very, very interesting nevertheless. And if you're looking to pick individual companies and not play ETFs, and you want to know which are the best 2 or 3 or 4 companies by way of each industry, excellent, excellent resource here. They cover all the industry sectors. You can drill down, you can look at all the banks, and you could see the Bank of America is number 1. And, oh, I like this bank. Yeah, but it's number 42. You know, so if you're an ESG person, that's not the one you're going to own. So look at the top 4 or 5 names and figure out which 1 or 2 you want to own, and get a lot of comfort in knowing that this company has got tons and tons of resources looking at all these considerations within the whole framework of ESG, so that they're doing all that work for you. There's no cost to you at all to do that work. You don't need a massive research team. Or if you like what they're doing, you just go buy the ETF. But that, you know, will work for a lot of people. What I'm showing you here is the difference in the weightings between the just ETF and the benchmark. And the benchmark in this case, I'm using the S&P 500. And you can see there's no real material, you know, bet differences between sectors. They're all like pretty darn close. Overall energy's higher, and it's taking a little bit from the consumer and a little bit from telcos, the communication services. Energy's like right on. So what ETFs are in the energy, or what stocks are in the energy sector? Well, they're going to be the ones that are probably their top 4 names. And so you can go click and see which ones they are. Anyways, it's a great ETF. And I think, you know, have a look at it, go to their website. Just a great, great resource for individuals and do-it-yourselfers. I use it. I use it in the ESG fund we're launching. It's going to be a core screening tool for us in terms of determining, you know, which companies are going to make our list of ones we want to own and trade. Okay, so I talked about water scarcity, and I was reading some research a couple of weeks back, and I saw this incredible stat. It just led me to remind myself of a grade. I'm thinking it was grade 5 or 6 or 7, maybe 8. We went on a school trip around that time frame, and we went to, I think, Stelco in Hamilton, and we saw how the steel was made and the smelters. And I remember very vividly the guy who was doing the orientation for us said, the Hamilton Bay water, that whole, you know, you cross the bridge over to come here, that from the bridge over, that entire pool of water once a month was recycled by the plant to cool down the steel. And I thought, wow, you know, that to me, that was, because I'm very visual, and that stuck in my head. And to this day, when I talked about water scarcity and clean water, and, you know, the use of water in growing food and livestock, and listen, water is the core part of life. Without clean, drinkable water, nothing exists, right? So water scarcity in lots of places of the world are going to matter. And so this research piece I was reading on the copper market, they haven't invested in new copper mines because the copper price was depressed. It takes 10 years for a mine to come on. A lot of it is in Chile. Chile doesn't have enough clean water to build the infrastructure. Like this whole piece here on why copper, but ultimately it was why copper prices are going to stay high, but it was related to this, and so it got me thinking about this area again. And so there was an ETF I've been using on and off for years, PHO, and it's actually got about a 15-year history here. And you can see in the total return compared to the total world index going back to 2008, that just the water sector has kept up with the broad world stock market. So that's pretty interesting, and at times outperformed, at times underperformed. And the idea is for a lot of these thematic things that you might want to include in your portfolio is that you want to buy them when they're cheap. You want to buy them when they're depressed, not necessarily when they're breaking out to new highs, because yes, it could last for a while, but ultimately you're going to get some sort of correction. Why? Because you always get some sort of correction. Things get overvalued. And in my lens, where I'm a value investor, I like buying things when they're cheap. I've talked about that, many times. So there's 6 different ETFs that I've looked at. Aqua is the newest one, and the one I kind of featured a little bit this week, because it's the clean water. It's not the water resources, not the global water, it's not the water, it's the clean water one. And so there's an emphasis in this one on water, not scarcity, but cleaning water, purification. So that part of it, and that kind of. But when I look at, if I'm looking just at the returns, and I'm looking at, now the reason I have a 5-year lens on here, and the reason there's no 5 years is because the Aqua one's only about a year old, and so this way of looking at the total return between the price, the dividend, the difference between the price change and the total return is the dividend. Then the last column there is annualized. And so I compared everything to PHO. And so if you looked at it and just like this, you wouldn't necessarily choose the Globex clean water one, because you would say, well, it underperformed. And this is where you have to understand what's in the ETF and what you're investing in, that they're all a little bit different. They're not the same index. It's not just about buying the one with the lowest MER. It's really understanding what you want to get out of it. And we get so many common questions. So Larry, which one should I buy? So I don't know what you want in your investment to tell you which one you should buy, and which one I would buy may not necessarily be the same thing you're looking for. So, it depends on the question on the ETF on how you would kind of go about that. But anyways, so water scarcity and Aqua right now is the one that's on my radar to purchase, and I don't own it today. The next ESG thing I looked at is the carbon markets, and this is a relatively new. In a handful of years, it's been out in Europe longer than here. They're way ahead in terms of their ESG, for good or bad, and all the stupid decisions that Germany's made necessarily about nuclear and now having to use more coal. I mean, ESG has caused this issue. It's very, very bullish in the next few years still for traditional carbon, and if the ESG thing doesn't bother you, then the energy markets. But make no mistake, I know there's a lot of guys harping, talking about $150 oil and $180 oil, and listen, they're telling you a story to sell their product. I don't know if it's real or not. I've heard the market neutral people and talk about those price targets too. So it is possible. Will the underlying stocks price in a long-term oil price there, or was that a spike? So again, it's tradable in the traditional carbon energy markets. So this is a whole way of playing carbon allowances. And so the narrative in this whole story, again, some links there for you to look in a little bit deeper. And Crane Shares launched the first carbon-based ETF, and it's linked to an index, and they kind of show you the different futures markets here and what you're owning. Futures contracts. Don't try to trade these futures contracts yourself. Kind of leave it to the professionals. But here is an interesting asset class, and basically, what they contend is that in order to meet the climate goals set out by the world, the price of carbon needs to double, and then probably double again from approximately from where it's trading today. So again, is this tradable? Is it investable? Should you buy it today? It's on my radar. I'm still trying to learn a little bit more about it. It's futures market based, so you've got that forward pricing and NAV erosion that's typical with futures markets, and I don't have a great sense yet. But this is an interesting alternative type of ESG investment that will be part of the universe of things that I invest in my ESG fund, along with some of the other things I talked about tonight. But I don't own it today again. So that kind of covers my ETF view, those three: the hydrogen, the water, and this new carbon ETF. I could go on for another hour on the thematics ideas I have, but I wouldn't leave any time for questions, and I wanted to leave a lot of time tonight. But for the stock pickers out there, I thought I would take you, on a deeper dive quest on how I would say, okay, that's great if you want to use ETFs, Larry, but what if I want to pick stocks? And so, carbon, there's another side to it. And some of the research I was doing, again, came across an article that was published recently, that if we go no carbon, it's interesting how CO2 is captured and used. And so the bad CO2 goes up there. The good CO2 goes into our Diet Coke and into other products that we make and use for fertilizers and all kinds of other things. But the carbon markets are apparently 6% of our food consumption. And so if the price of carbon goes up, that's going to filter into the cost of food and certain products going up. So do you want to buy or sell Coke or Pepsi as a defensive way to be invested if the multiple on those stocks are higher? So those are kind of some of the knock-on things that I kind of think about. And I thought, well, what company, would I buy today that actually is going to grow if the cost of CO2 and CO2 capture is going to increase in value? And so all that put aside or included, the answer is Pentair. And this is a stock that is in my universe. It filters well for ESG ratings. I didn't want to own it for all of until recently, the last month or so, where it now meets my criteria in terms of potential profitability, in terms of everything that I kind of look for. But when it was trading 75, 80, and everyone was really excited about, the growth side of it, now we're not. So the PE of the stock is attractive, and it just reported earnings today. I thought that was also an interesting thing, and the stock didn't behave particularly well. I had originally purchased it a couple of weeks ago, probably if you look at just maybe 10 bars ago, on that relative new low there, because I like to buy into weakness. So I put my first tranche. It retested that low, it reversed, it pulled back to that today. I added another piece. I averaged down a little bit on the position. I now have a 1% position in my growth fund. If I was maximum bullish, I would be 3. So it's a third of a position overall, about a 1% position for me, and a 100 stock portfolio on average is about neutral. So, I like it here, and I would buy it today. And this is one that, it's got good ESG. It's playing in the right space. They're on the right side of the trade. There are some near-term issues that are responsible for the relative weakness over the last 3, 4, 5 months. They're probably fully so in my option-based strategy, where it's the ZPay model, I wrote puts at 45 to buy over the next few months. I'm earning a 1% yield while I'm waiting for those. So in that model, I'll buy it at 45. If it doesn't go down that low in my stock model, I'm at 1/3 long right here. And that's, again, another idea for you guys. So we have about half an hour left in the Q&A. And let me dig into this, and hopefully we can get through a lot of questions tonight. And I'll try to be as brief as possible. but I do like to dig in sometimes and give some depth in the answers versus the 30 seconds per answer that I get on TV. So ZPay, increased volatility and therefore riskier for investors. So let me bring up this and bring up the ZPay. So on a year-to-date basis, the ZPay relative to the broad S&P 500, you can see when the market sells off more aggressively, ZPay goes down because they're long on average about half the stocks. So in the covered call and the options. So they're always generating that 6% yield. You can see the total return over not quite 4 months yet. 1.5% is the yield component of that, but there's some price loss in there in terms of the difference between the S&P 500 that over a year is going to yield a little more than 1%, and has more price volatility to it. So again, the question there being, in this environment, is ZPay seeing increased volatility and therefore riskier? So the benefit of increased volatility is that the option premiums go up. So as they're writing the new options every month, they can write them further down, take the same yield, so less risk. But if the markets sell off really quickly, kind of like it did during COVID, that, a 3-week drop of 35%, doesn't matter what strategy you're in to protect, you're going to see significant volatility. So then the comeback to this question is, what kind of decline do you think we're going to get? And I think it's not going to be an acute shock like we saw with COVID, but as they're raising rates and that filters into the real economy and earnings start to reflect that and we start to get the downgrades, it's more of a decay maybe over the next 6 or 12 months than it is a crash. But the higher volatility means ZPay can take less risk and earn the same yield or increase the yield. They're not going to pay out more than 6, but that would add to the total return of the fund, keeping the options at the same level. Great question. Okay. Trying to talk myself into buying TLT, long bond ETF. Looks like support at 117, positive divergence. What am I missing? Okay, so I prepared some charts here for you. So let's have a look at TLT here. And the way I look at it, trend channels, bottom of the trend. So I like it here. I've actually been accumulating it for the last few weeks, and I'm building a position in my BMO Balance Fund where bonds are a mandate and I have to own them. Where I don't have to own bonds, I wouldn't be buying them yet. But where I do have to own bonds and having no duration exposure at all for most of this decline, I bought some in here, I traded it out. I'm now adding duration. So, person says, well, 117, there's some support there. So here's where we kind of go back in time, and they're looking at this, from 2018 and saying that support. Well, so here's where that lens is wrong. And you have to actually look at the underlying yields. So here's the table on Bloomberg where you have the bond curve and the yields. And so what you own in TLT is 20 to 30-year bonds, basically. Well, it's actually 10 to 30, but they issue 10-year bonds and they issue 30-year bonds. They're starting to issue 20-year bonds. Look how kinked the curve is. So you basically have 10s and 30s flat, but the period of the term that the market doesn't look at and pay much attention to, which is the 20, actually has a higher real yield. So the futures market is based on cheapest to deliver, and right now the cheapest to deliver is the highest yield part of the curve, and therefore the 20-year bond is the cheapest part of the bond curve. All that goes into the mechanics of TLT, by the way. So when you look at what you're owning, let's look at US GG30. So what this is basically the 30-year generic continuous 30. So this is always showing the current 30-year bond yield, because at the end of the day, this is what you're investing in. So, person said, well, there's support at 117. Well, the reality is from that 2018 sell-off, the yield support for the 30-year is up at 345. We're currently at 293. So if we're going to test that yield support, approximately every dollar in TLT is worth about 4.5 basis points. So you do the math based on the current price, and you're looking at not the TLT level, but the yield level, and that kind of falls in to about $10 lower than it is today. So asking what you're missing, that's what you're missing. AD line over, none of that matters. Okay, none of that matters. You're trading interest rates. You got to look at the bond. If stocks are going to sell off, money's going to flow into duration. If we're going into a recession, duration gets interesting. That's why from here to there, I like it. I don't know where it's going to stop, but somewhere between here and there, it's going to stop. And every little bit interest rates goes up, I'm adding 10% position in the TLT is my limit. And I'm currently just under half of that in terms of my exposure. So that's how I'm positioned there. Great question. Could you recommend a good book / website on factor-based investing? Boom, there it is. So in the link, you'll click on it. I'm going to throw this up into here now. So hopefully we can all see it. And so research affiliates, understanding factor investing webinar series. Boom, there you go. So great question, great resource, research affiliates research amongst some of the best. I feature it all the time on the educational part of my show and use it extensively in my work. So there you go, great question. And fortunately, and not always, sometimes there just isn't a good resource for the do-it-yourself investor, but that is certainly an excellent one. On your weekly fund update, would you be able to explain the information on the fund highlights document for the various funds and how to interpret the information? One more question, on preferred ETFs into a retirement portfolio, where do they tend to perform best and so forth, and how do they correlate? The answer to that is probably half hour long in terms of understanding perpetual bond preferreds, reset preferreds. They're different in different markets, different ETFs focused on different things. That whole market's changing with the LRCN. So there's no simple, easy answer on the preferred side of that question, and really would need a much deeper consideration. And so I don't have the time to spend on that tonight if I want to get to all the questions. Very quickly, on your question related to my weekly sheets here. So here's the three ones. Here's the growth fund. Obviously, what the current top holdings are in the ETF. My chart of the week this week, I wished everybody a happy Easter and Passover. There's a couple other holidays also this time of year, but you get the message. I comment on what I'm thinking about. I have a link to my Pro Eyes indicators, how much protection's in the portfolio right now. So the delta, the option structure delta is minus 25, but it's protecting 50% of the value of the equity in the portfolio. That's the structure that I have on the portfolio now in terms of volatility. This is self-evident in terms of what the portfolio has done by way of risk and return relative to the global low volatility benchmark versus the entire world. And then the various returns, the different exposures by way of region of the world, by way of a look through into the ETFs, the sector exposures compared to the benchmarks, my current US exposure, beta, again, risk factor, the protection, the delta of the option strategy is the hedge, correlation to world markets, the current yield, the number of holdings, the annualized volatility, and just the Canadian dollar level. This is the net exposure by way of risk and what we've had in the portfolios historically since inception, and same with the Canadian dollar, US dollar risk exposure. So those are posted on the ZZZ Portfolios website every week, and you can refer to those. So hopefully that was good enough. So apologize I couldn't do the preferreds. Can you please give us some color on what has typically happened to gold investments leading up to and during a recession? So I prepared this chart for that question. So all these burgundy shaded areas are US recessions, spot gold pricing going back over history. This is a monthly chart. So when these bars created, that's when Bloomberg started to track daily data versus periodic or intraday data, pardon me, versus periodic and so forth. So you can see going back in time. Now, prior to 1972, the world was on the gold standard. So the early 70s recession, nada, gold was fixed. They release gold from the gold standard, gold prices start to rise, high inflation of the 70s, recessions. So this gives you a good snapshot on what it's done, but the reality is, what does it mean today? Because the 70s don't matter a whole lot. There was no Bitcoin, there was no competition, there was no ease of back then you had to stand in line and buy gold bars. There was no easy way to trade them. Today, the liquidity is very different than it was before. The alternative types of, if you want to call it digital gold, which I think is nonsense, but whatever, people are considering it that way. So there's all kinds of things that are different today. So I think it's very hard. Your question is good, but it's very hard to go back in time and say, this is what happened to gold. You can actually see that sometimes nothing, sometimes everything, sometimes a lot of volatility. But what you will find is there's other factors that were driving the volatility, and it wasn't the recession. So good question. Very little correlation is the answer. And today is very different than historic. Again, very good question. And then the final question here, before I go to the live questions tonight, appreciate feedback on the new Canadian depository receipts, pros and cons to investing versus directly into the US stocks. First, I believe there's fractional shares, so you can buy smaller portions. I believe there's hedges and non-hedge versions, so that's available. And depending on how you invest and trade, do you have to pay the FX cost every time you buy and sell a US security? That adds 2% cost every trade. So how does what you do work? And that's going to matter whether those are better vehicles for you. I think on average they could be, but there are some do-it-yourself platforms where the FX costs are either minimized or you only have a US dollar account, and therefore the FX isn't a big consideration. But for a lot of people, the cost of the FX back and forth into Canadian dollars matters. So you have to consider so many different things. Those are some of the pros and cons I would consider. I have not used them. I've not really done any study on them. I don't need them for what I do. So, I'll promise to put on my to-do list a deeper dive on them once they get a little bit more mature, and maybe 6 months or a year from now I can do a feature on them. Maybe I can have someone from the exchange come on the show as a guest once we go back to live studio audiences and I have that capability again, and so forth. So, good question. Let me go to some of the live questions here and see what we got. Is there a good source that you can recommend that tracks a shorted ETF, the position shorted? There's an ETF that does that. Boy, I get pitched by these guys all the time, and it's not something I've focused on, so I really haven't done any work. But there is a firm out there that tracks the short exposure, but the reporting of it is very, very delayed. So if someone shorts something, they have to report it within approximately 10 days. And if you're an insider, all those things kind of have a little bit of lag to it, and they're not in real time. So the information you get from that is not great in my mind. But it's out there. The Reddit community has, when hedge funds report their 13Fs, you have to go to the CDAR systems and you got to read through those. And, there's a company out there that does it. The name is on the tip of my tongue. I can't think of it at the moment. So apologize for that, but it's a good question. There is one out there. If I think about it, I'll put it out, or maybe I'll tweet it out. Be good to hear any comments on U.S. pipelines, energy transfer, undervalued, etc. So let's have a look at. Okay, so to average analyst price target, just under $15 right now, and so this would meet my requirement in terms of profitability, the price target. One thing I like to look at is how wrong the analysts are over time, and if you look at this, so this is very interesting here. The stock has never, ever, 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 I can go back, it's never traded to what the analysts think it's worth. And in fact, the average spread to what the analysts think it's worth 1 year from now hasn't been achieved in the better part of a decade. So you got to take 20 or 30% off this price target. And so at 12, it's probably pretty fully valued here. and I wouldn't touch it for that reason. So this is some of the things that you can do if you have the tools. And so good question, but that's kind of, and I wouldn't touch it here. Where would I? It would have to pull back relative to the benchmark, by a good 20, 30%. So at a minimum, around this 200-day average, probably on a dip below it. What would it take to get there? It would take oil prices to cool off and markets to cool off, quite a bit. And, that might be coming. I wouldn't touch them today, and I don't have any exposure. Okay, next question. Could I please comment on the U.S. pipelines versus the Canadian? Okay, so similar question from the same person. I generally, my lens on them is that they're pretty fully priced here. The yields, of course, are attractive, but buy on dips, I wouldn't be adding here, and in fact, I would be selling and lightening up from a trading perspective. Okay, with the Bank of Canada rate rising and putting pressure on mortgages, should we reduce our exposure to banks, ZWB? So, when you look at a bank's risk relative to mortgages, so one of the reasons you would sell ZWB isn't necessarily related to a risk of rising mortgage prices. If people were losing their jobs and we were going into recession and there was going to be foreclosures, the vast majority of mortgages are securitized and not, that risk isn't sitting on the bank balance sheet. It's been spun off into a mortgage-backed security. There's definitely some risk on the mortgage books. They tend to be more commercial type loans that are the risks, not mortgages on individual homes. Those tend to be securitized. But you know, the profitability of banks, which I covered a few weeks ago, has everything to do with the net interest margins. And I did a deep dive on that a few weeks back. You may want to go back and look at that webinar if you can. But if market risk is market risk, and you're going to get a broad market correction, you know, banks are going to go down, and you would be selling banks at this point more for that market risk reason, and the potential recession, not that mortgage prices are going up. Okay, so that's kind of that lens. It all has to do with the profitability and the yield curve spread, right? So keep that in mind. Okay, next question. I mentioned the R word for mid-23 without going to cash or bonds, safe long-term investments. So Louis, so next week, private credit markets, private equity markets, they're not for the average smaller capitalized individual investor. Those markets tend to be for very, very large investors, but there are investment solutions in the private markets where you can get yields of 6, 7, 8% with a lot less risk than traditional markets where you can wait out. Many of them have liquidity issues, which I'll cover next week, but I believe the private credit markets on a diversified basis specifically offer a lot more protection during bad economic environments. The trade-off and the give up for investors is the liquidity, and that, you know, if you wanted to take the money out, sometimes there's a month wait, sometimes there's 3 months wait, and you can't be as tactical with it in terms of reinvesting it into equities after they decline. But I think it's a very important asset class as we go through an inflationary phase where traditional 60-40 type investing and the R word or the stagflation word, the S word, is in front of us. I've held TFTN for a long time. It's paid a very good dividend with the changing economic background and concerned about the fund, Canadian banks, US bank. FTN. This sounds like one of those split share jobbies. So let me bring that up. FTN. Yeah, financial split. So, you know, when I looked into this in the past, I believe there's a little bit of leverage in it, depending on which unit it is. So this one, I believe, is the pure, you know, yield play. Again, you got to look at it from a total return perspective, and not everybody can see this on a lot of the lenses they would have, but it's been around for a long time. I'm not sure how far it goes back, but I'm just going to put in the year 2000 here and see what I end up getting. 2003 looks like since inception. That's the Canadian dollar total return since inception, 5.51%. The price change down 70%, the yield 168%. So, you know, I think this is a crappy investment, but it's not what it's promised. It's marketed as being a big yielding thing. Let's look at that against the ZEB lens. It's not going to go back as far because the ZEB doesn't go back that far. But just looking at it from that lens, okay, different perspective. How about ZWB? So this is very similar risk. It doesn't have the insurance companies, it's just the banks. Question here, Robert, which one would you rather own? So again, next piece, how volatile is it during volatile markets compared to just the banks? And what you can see here is crazy volatility compared to just owning the banks or ZWB or ZEB. And so that's coming. I can't time it. I don't know when it's going to happen. I don't know for sure if it's going to happen. But if we go into a bad equity market, you're going to get way more volatility in FTN, which I'm sure you've experienced if you're a long-term buyer of it. But I would argue that a ZEB or a ZWB would be a way to extract a good yield, keep exposure to it, and probably have a lot less risk. You know, if we go into a bad, if you need the yield, but also consider if you need the yield, you know, ZWU, it's not the 10 or 11% that this thing claims to be spinning out, but, you know, and a ZWU again, you know, what is that going to do for you? You know, it's 6%. It's currently yielding 7. It's another, you know, kind of exposure. Now you kind of look at this and you say, well, FTN did 13.49. It just happens to be that point in time where FTN was at a low point, you know, going back in this case into 2011, which was kind of the bottom of the market. But if I took a 5-year lens, you know, and looked at that number, would you own FTN? Right? So it's all a matter of doing proper analysis, but you know, great question. And the answer is it's something you know, I would avoid and look for an alternative if you need the coupon. Private credit markets, there are solutions there. So if you have enough, I'll talk about it next week, tune in. If you have enough capital, these markets are probably something you want to look at. Last question, precious metals. Streamer on gold, what's your thoughts on wheat and precious metals? James, you know, I like those plays. They're more defensive ways of getting exposure. Franco Nevada is a good one in the US. You know, Wheaton's good here. So if you want to play the sector and you want to do it defensively, those are better ways to do it. If you want to be aggressive and you're really bullish, you know, small cap, junior, leverage to the upside of gold prices. What am I doing right now? I've been reducing gold exposure into strength. It just hasn't worked. It's been a high conviction position for me. You guys will know that. I started liking it years ago. We made a lot of money in the gold sector, but for the last year and a half, it should have been doing more. Gold should be doing more than it is. It hasn't. I'm not a gold bug, and I'm trimming right here, not adding at the moment. We pull back 10 or 20%, then I'm thinking I'm adding to the position. What's my risk reward ratio enough for the next 12 months to hold large amounts of cash? Again, so I have no issue at all with holding cash, but it's an emotional thing. If you're the kind of person emotionally that you got a lot of cash and something's going up and you're not participating and that bothers you, and eventually you jump in because you don't want to miss out and then you buy it bad. If you're more emotionally sensitive to the market, you're going to have a tough time trying to time it in and out, because emotions are going to drive your investment decision, not the cognitive rational part of your brain. I could paint you a scenario where we're just fine for the next year and a half. The rise in interest rates aren't going to be too troubling. You know, just listen to the BMO strategist, Brian Belsky. You know, the eternal optimist. He's always got a great story to tell and why certain sectors and stocks So again, use of cash is a personal thing. It's not something that anybody should be advocating, but my portfolios that are focused on equities and equities only are positioned as defensively as I can put them right now, and maybe just a little bit more I can do on that, but not much. So I'm positioned defensively. If that means a lot of cash, then great. So listen, folks, thanks. One more week. Please consider a donation to one of our charities. Cancer Research at Sick Kids, Dementia and Alzheimer's at Baycrest. We're thrilled to match your donations, and consider visiting one of our sponsor websites for more information. Have a great week, everyone.